So I know it's hard to believe, but the Fed just cut interest rates for the first time in 2025. And for investors like us, this changes everything. On the surface, it looks like free money. Stocks go up, borrowing gets cheaper, and the economy gets a huge boost. But in reality, it's not that simple. There's some winners, there's some losers, and there's some huge risks if you're not careful. The Fed just lowered the benchmark rate by 0.25%, bringing it down to 4.25. Now, that may not sound like a lot, but this is the Fed signaling that the rate hike era is officially over. And they've even said that we could see two more cuts by the end of this year. So, for context, rates were almost at zero just a couple years ago, then inflation shot up, and that changed. Now the Fed is pivoting because they see the economy slowing down. Nobody's working, and inflation just is never going to go away. So let's talk about how to position ourselves as investors for this and how to keep going forward. So historically, when Fed cuts rates, stocks usually tend to rally. And here's why. Because when Fed lowers the rates, that makes bonds look less attractive. So nobody wants to invest in bonds when you could take your money and move it over to the stock market. But in reality, it's not a guaranteed win. If the Fed is cutting because they're worried about a recession, that can drag earnings even lower. So this isn't just about rates, it's the reason behind the cut. So if you're invested in bonds, this is huge because when rates fall, existing bonds with higher yields become more valuable. So if you're invested in treasuries or bond ETFs, you could see some price gains. But if you're just looking to get into bonds, you want to make a decision pretty quick before all the banks start dropping their rates even lower. So this is pretty much the moment where you have to decide if you want to lock in gains or if you want to keep riding the wave, see if even more cuts come. So this is where things get interesting because lower rates usually mean cheaper mortgages, which brings more buyers into the market. But right now, housing affordability is still crushed by high prices, and people are also starting to build more just to rent. But in all reality, real estate doesn't track the Fed exactly. They track long-term bonds. If the 10-year yield stays elevated, mortgages won't drop nearly as much as people think. And then there's crypto. Rate cuts usually mean the dollar is weakening since they're turning the printer back on, which historically has been good for Bitcoin and Ethereum. But let's be honest, crypto still trades like a high volatility growth asset. If this cut sparks a rally in equities, crypto could follow along. But if it sparks fears of a recession, people could start moving their money into safer assets like gold or silver. But here's the thing that we don't want to ignore. This cut could actually be a red flag. It's telling us that the US is more worried about the economy than inflation. Unemployment could rise even more, and that soft landing that everybody's been hoping for might be slipping away more and more. So, in reality, this isn't time to get overly aggressive, but I'd say be smart, pick your spots, and protect your downside. So, what should we as investors be doing right now? So, stocks, I'm sticking with high quality companies with good balance sheets. Rate cuts help growth, but if the economy weakens, cash flow is king. If you're holding long term treasuries, you could benefit from the downside a little bit. But if you're sitting on cash and you're thinking about locking in a yield, do it before the next rate cut. So for your cash and savings, expect those rates to start dropping. So that 3.5% high yield savings account that you have is probably going to be moving down to 3.25 now. So with stocks, silver, and gold, we saw a little bit of a drop as soon as the rate cut was announced, but crypto rose. So I'd keep it diversified as always. Don't have all your assets locked up in one place. And I would just keep dollar cost averaging. So, as a community, here's what I think we need to keep our eyes on. So, first, the next Fed meeting is in October. Are they going to follow through with another rate cut? And the inflation data. Is it actually cooling, or do we need to keep our eyes out? And third is the labor market. So, if unemployment keeps jumping more and more, that's when a recession gets real. So, in reality, this rate cut is less about celebration and more about preparation. Rates are coming down, but the economy is slowing. And as investors, we need to be ready for both outcomes. I'll keep breaking this down for you guys as soon as more data comes out. Now I want to hear from you guys. Do you think this is a bullish sign for stocks? Or do you think that the economy is going to keep slowing down? Let me know down in the comments. And if you found this helpful, make sure to like and subscribe. We're building this channel as a community of smart investors. and I'd love to have you along the journey. Plus, don't forget, we're running a giveaway. At 150 subscribers, we're going to be giving away $10 in Bitcoin, and at 1,000 subscribers, I'm going to be giving away a 1 ounce silver round. So make sure you subscribe and get in on that.